watching The Money Show on ET Now. I'm Mubina Kapasi. This is your one-stop shop for everything to do with your proper financial planning, getting your personal finances right, and of course, setting you on the path for long-term wealth creation. Let's tell you what we have lined up on today's episode of The Money Show. Midcap and small caps. That's one category where investors may have invested in the last 3-4 years, but they've really not been seeing returns. Even in fact, in this bull run that we are currently sort of in the midst of, where the Nifty is at lifetime highs, the Sensex is about near lifetime highs. The mid and the small cap index are still taking a bit slow. In 2020, their returns have not been as much as we have seen in the large caps. So, as investors in the mid and the small cap fund, is this something that should worry you? Is this a reason for you to perhaps rejig your portfolio, increase exposure to maybe large cap funds, so on and so forth? That's what we'll be discussing, and more importantly, how to recognize which are those funds that really could be duds and it's time you sort of move out from them. How to identify those, we'll be getting a check on that as well in our very first segment. Well, later on the show, there are some small cap funds that have managed to shine, and how. One such fund is the BOI AXA Small Cap Fund, or the BOI AXA Small Cap Fund. This one has managed to deliver a 50% return in the last 1 year, beating its benchmark, which is the Nifty 100 Small Cap TRI, through and through. So that's who we will be bringing on board in our Meet Your Fund Manager segment, Mr. Ajay Khandelwal, who manages the fund. So it's an action-packed day on The Money Show, and of course, as always, we will be answering the questions and queries that you guys have been writing in to us on our email address, themoneyshow@etnow.tv. So without any further ado, let's kickstart the show. We have with us our very first guest, Mr. PV Subramanyam of Subramani.com. Mr. Subramanyam, always a pleasure having you with us on The Money Show. Thanks so much for taking out time to talk to all of our viewers today. Well, let's first talk about, what do you think of what we are seeing in the mid-cap, in the small-cap companies' share prices? The two indexes or the indices which sort of represent the smaller and the mid-sized companies show that, while the market has really rallied, the Nifty and the Sensex have rallied, they're at record highs, the small and the mid-caps have still moved at a slower pace, or rather bounced back at a bit of a slower pace comparatively. They as well are in the green. But nevertheless, investors may think that, why am I not getting the kind of returns that I got in my large cap fund, or, maybe my Nifty 50 index fund. So let's get in a word firstly on, why do you think it's the small companies and the mid-sized companies that are not doing as well as the larger ones?
I don't know what is the day for which is better and let's just put it this way. When a large cap company like Maruti does well, it is fairly obvious that its suppliers like Float Glass will also do well. There will be a little bit of gap between the two, but absolutely I don't know who says that when this will do well, that will do at the same pace and things like that. From where do people get such theories? There is no such thing that large cap is doing well and mid cap is doing well. They will take their own time. Sometimes this will do well, sometimes that will do well. There is absolutely no correlation and nothing to say when large cap does well, this won't do well. So both will do well. Some will run at a faster pace. But during times like COVID, companies which are bigger are supposed to be more stable, and companies with more cash, like say a Reliance or a Facebook and all, are supposed to be able to take the hits better. So during COVID times, very obvious that large cap would have done better than small cap. Doesn't mean small cap won't catch up with them. Maybe in 2022 they will catch up. But don't try timing the market and saying this is what I should be doing. Doesn't matter for the retail investor which is doing well and which is doing bad.
So, just to sort of, give an explainer of sorts as well to those individuals who are watching, who perhaps are trying to learn as well in terms of equity investing, do you usually notice, in all your years of experience, that when there's a crisis, people do want to sort of flock to the larger names, the large cap names? I mean, the COVID crisis may have sort of prompted similar investor behavior. So is that a tendency that you've seen?
Maybe investor behavior, but look at company behavior. We saw one of the worst pandemics in the world. Never ever have we seen such a bad pandemic, and we saw Tesla going up 10 times, read my lips 10 times. You never know. I mean, predicting the market seems to be a very stupid game. Nobody has a clue as to what the market is going to do. But look at the amount of money that is flowing into the market. That is huge. So I don't see why we should try to say this will do well. Look at the fact that the largest companies, perhaps not even making profit, but have done extremely well. Look at the FANG, look at Reliance. Reliance is making money. The big companies have done extremely well, but so are some of the small caps, right? So both have done well. So trying to find a pattern seems to be a very, very foolish game. I can't find a pattern over the last 40 years. We unnecessarily try to fit in a pattern after the event has happened, and I think that is dangerous.
All right. So if you can't, then you definitely don't advise retail investors as well to really play this market tracking game. Definitely not advisable for mutual fund investors. And hence, Mr. Subramanyam, for those mid-cap, small-cap fund holders, who are, looking at the CAM statement and seeing that the return from the mid and small-cap funds, especially those who may have invested in the last 3-4 years, has not been that great. Would you advise them to sit tight at this point of time and not really indulge in this, review, rebalancing at this point?
Mubina, what happens is when you're given some set of data, you think you have to act on that, right? That's not true. Like, for example, we all know how many people died of COVID. We have no clue how many people died of dysentery. Maybe there are more deaths happening in India because of dysentery, but that is not a very exciting data, right? So exactly when you get your statement, if you see a fund has given you minus 12% and another fund has given you plus 12%, actually use your intellect. Actually, it is in the minus 12 that you should put in more money, right? Because maybe in the next year that will do better than this. Unfortunately, we chase performance and that can be very harmful. Don't chase performance. You've got sensationally good returns in the market over the last, say, 8-9 months. So don't be chasing performance is scary. I would take some money off the table from large cap rather than worrying about small cap performance.
All right. Well, yes, I mean, when, the performance has definitely been sensational, especially, in the large caps in the last 7 to 8 months. So, logically speaking, of course, if you still have to take some money off, you rather take it off from large caps because, there's been a good amount of rally. Many of you may have also managed to earn quite a fair bit in terms of, NAVs, etc. So, when you are assessing, and Mr. Subramanyam, we've had this conversation with you in the past, that while we always say that mutual fund investing is for the long term, it's a good practice to sort of review your funds from every parameter. So what would be the points that you would take into consideration when you are reviewing your portfolio on an annual or, semi-annual basis?
I would first of all do goal-based investing. So if I know that I require money over the next 2-3 years also, or maybe even 4 years, look at some fund which is a energy fund or a healthcare fund, and I'm seeing in the last 17 months I've got 118% return or something as vulgar as that. I know that this can't get repeated, right? So taking some money off that and putting it in your goal, which is required over the next 3-4 months into a debt fund makes sense. Not because I think the returns won't come, that is of course there, but largely because I need the money over the next 2-3 years or 4 years, and I know that 118% gain can be followed by a minus 42% or something like that also. So therefore, I will take some money off, but if I don't require the money over a 10-year period, I will not bother. But what could have happened is some money which you needed, in 2023 or 24, you may have invested in 2010 or 2012, and that is now coming 30. So that money I will definitely remove. But yes, too much of cash is changing the market, chasing the equity. So obviously this is bound to happen.
In fact, I think your strategy is something, thankfully, that at least if we go by the AMFI data, which was just released today, large cap funds have seen a net outflow of more than 3,200 crore rupees. Multi cap funds have seen a net outflow of 2,800 crore rupees. Now you compare that with a mid and a small cap fund, it's relatively been a bit more modest. A small cap fund has seen a net outflow of a little over 1,000 crores, whereas mid cap funds have seen at 1,300 crore rupees. So I think, yeah, the market as well largely seems to be doing that. They're looking at, the great performance seen in large caps, and, they're thinking about taking some money off, the market. But of course, the hope is that, you're doing so because you know that there is a financial goal for which you had invested in these large cap funds, which may be approaching, like Mr. Subramanyam said, and it may be 1 or 2 years down the line or 3 years down the line. And hence, you sort of take that money and you perhaps park it in a debt fund, which relatively has a little lesser volatility compared to, other funds. Mr. Subramanyam, would you say that meantime a small cap and a mid cap fund would inherently be a little more volatile? Go ahead.
See, if you want good returns in equities, you have to learn to understand volatility instead of being scared of volatility, right? All of us have seen volatility. I mean, 2020 has been such a lovely year for students of volatility. In March, how many of us thought in November we will see an all-time high? Most doomsayers are saying market abhi upar jayega. That is not true, right? So that is what has happened. So don't worry about volatility. Take a small amount of money and take a 10-year view on volatile funds. You will definitely get a good return. Be very clear that you're taking a 10-year view. Don't look at it on a daily basis. That's not your job. You don't understand how to look at volatility. Don't look at volatility.
All right. You know what? We were speaking about the AMFI data that we saw, and about how it's the 5th consecutive month that we are seeing net outflows from mutual funds, which essentially means that people are redeeming more than they are investing, despite the fact, of course, that the markets are a record high. So it's clearly a bout of profit booking of sorts. So, we caught up with two big mutual fund companies. One is Aditya Birla Sun Life's A. Bala, and the other, of course, Kotak Mutual Fund's Nilesh Shah. Listen in to their perspective.
One of the reasons that what could probably think about is the way we saw a fall in the market post-COVID declaration in the month of March. Very sharp fall came. So one cannot forget that it was a scary momentum at that point of time from the market reaction point of view. And that's something which I think the market, the way it bounced back. I think if you look at from the low that we saw, where people are a bit worried, that I still remember being part of the same show along with Nilesh and few other industry players, and giving the assurance to the people that, not more than assurance, giving some kind of comfort to the people that this is a one-time big fall, is adjusting to the COVID situations, and market will come back. And the way I think the regulators are taking steps, therefore the confidence will come back very soon, which has happened. Now, having seen such a seesaw momentum, and probably I would assume some element of portfolio allocations could actually happen between one asset class, other asset class, as Nilesh mentioned. That's one. And secondly, if you look at people are deeply in money before COVID, any investment that we have made in equity would have given you a significantly higher return or substantially higher return to the satisfaction of every investor that would have come into the equity. But the post-fall, they also saw some bit of valuation thanks to the mark-to-market. But now, having seen that coming back, probably the set of investors probably would assume that maybe it's a good time to reallocate my portfolio one to other. So that's, I think, the function of that.
So again, mutual fund investors are not a homogeneous group. They are heterogeneous group. If I look at retail behavior, the peak SIP flows were 8,400 crores a month. The bottom SIP flows was 7,800 crore a month. Now we are back to 8,000 crore. So by and large, retail SIP flows have sustained. And there the average collection is about 3,000 rupees. On HNI and family office, there has been some redemptions to fund their other opportunities, including businesses which required support during COVID-19 period. Some of the institutional investors have also done profit booking. Now there is one more element to mutual fund redemption. We also run asset allocation products like Balance Advantage Fund. Now, in Jan, we were at 40% allocation to equity. March, it became 80% allocation to equity. Today, it is back to 45% allocation to equity. Now, in this Balance Advantage Fund category, because market valuations have moved in a certain range, the equity allocations have come down. In our own case, we would have sold close to 1,200 crore of equities between, let's say, June, July, August to September, October in this particular fund. This is to bring equity allocation to neutral weight from overweight in March. As Farooq mentioned, this is the profit booking which we have to do because that is the mandate of the fund. Now, if you put all these things together, we do see normalization happening in retail flows. We do see normalization happening in institutional flows. However, the HNIs and family office space today is sitting on cash, and they have to get convinced that valuations of markets have actually improved rather than deteriorated with rise in index. Prior to September quarterly result, many investors thought equity markets were trading at 30-35 forward PE. The September quarterly profit for Nifty 50 companies came at 1,07,000 crore, all-time high in the corporate India's history. If I just annualize 1,07,000 crore into 4 quarters, that's 4,28,000 crore. On 100 lakh crore market cap of Nifty 50, that's a forward PE of 24, not 30-35. Now, the day family office, HNI, and other large investor gets convinced that this 1 lakh crore quarterly run rate of profit is likely to continue, I'm sure their allocation will also start shifting towards equity, and we will see normalcy returning in their allocation.
All right. Well, Mr. Subramanyam, let's also talk about another point that, a lot of investors have essentially been seeing in the mutual fund industry, in the mutual fund market, and that is, the continuous net outflows. And also the one question that we are asked very often, and that is how much of a portfolio should be in mid caps and small caps. And I'm sure your answer will also vary for different age cohorts and for different income levels, the nature of the income as well. So let's get in your take on that bit.
So, see, one more thing which could be the reason why people could be moving from large cap funds to ETFs, right? So that could be one thing. So you see ETF collections going up. So maybe some intellectually oriented investors are understanding the gap between the charges in an ETF versus a mutual fund. So some money could be moving there. That could be happening. Regarding small cap, mid cap, the allocation, definitely, like you said, it depends on age, ability to understand, and the ability to take risk, right? So, and what they like. For example, some people like mid cap and small cap, and they feel they'll get better returns, so they get more into it. But if you are asking me for a 55, 60-year man who's wanting to put maybe 50% of his money in equity, I wouldn't put more than 30% in mid cap and small cap put together. So something like 70% would be in large cap, simply because large cap can take more fluctuations and more bad times. And I think this is big. COVID is just the beginning. We may be hit once more in the next 4 or 5 years. So the ability to hold on to the share even during bad times keeps falling as your age increases. So for a 75-year-old man, maybe I will put just about 5% in the mid and small cap. But for a 22-year-old, I would do a lot bigger, maybe 80% in mid and small cap and 20% in large cap. But I will keep increasing it by 1% year on year. Every new SP I would rather do into a large cap. So I will keep fluctuating the amounts. And also what happens is some people like to take direct equity also. And in direct equity, it is easier to buy a Reliance or an HDFC than a small cap company. So what happens is I would put maybe 50% in large cap, but maybe out of which only 30% is in large cap fund and 30% is direct large cap investment. That is also happening because I see a lot of young investors preferring to buy direct equity and saying, why should I be paying 1 or 2% to a fund manager to buy Reliance or HDFC or HDFC Bank? We know these are good shares to buy. I don't know whether it is right or wrong, but that is also happening. So again, I'm answering both your questions. So therefore, some outflow from large cap funds into direct large caps, and also therefore people putting more money into mid and small cap because they have got money to invest. So all this combination is happening.
All right. Okay, well, there you have it, all about mid caps and small caps. The little bit of underperformance that we are seeing in these two indices. Of course, Mr. Subramanyam says that it's just a matter of time. We should see these indices and this category of stocks as well rebound. It's just that the large caps have a rebound faster. But for retail investors, really, especially if your goal is far away, it's not really something that you should worry about. And of course, predicting the market, is not something that really is where you should be, investing your time in. Okay, let's take on board some questions and queries meantime that we have received. The first one is coming in from Subramanyam Pichai. He says, what's the time horizon one should keep money in short duration funds, in medium and long duration funds, banking and PSU funds, and government securities funds? So all of them essentially are different categories within the umbrella of debt fund. Additionally, he's saying, what are the debt funds recommended for people who've retired at the age of 60? So our gentleman here, I think, has already crossed the age of 60. Mr. Subramanyam, what's the time horizon for all these different kinds of debt funds? We often say it's a little more short term in nature when you're investing in debt funds. So what would be your opinion?
So I would put, if my outlook is less than 3 months, I would go in for a liquid fund. Then I would go to ultra short for less than 1 year. Beyond 1 year, I would look at short-term bond fund, and then PSU funds, etc., where the duration is 3 years. Let me put it this way: pick up the fact sheet. There you will see the duration which is there for the fund, which for something about 6 months more than that. So if you are seeing a fund which has got a 3-year duration, for 3.5 years, you can take that fund as the best place to invest, and therefore after 3 years you should remove from that and put it into the liquid fund or ultra short bond fund. But in G6, I would suggest an SIP, because we have no clue how to predict interest rates for 10 years, and the G6, if you see, maturity would be 10-20 years. That is extremely long. So do an SIP in that. You are likely to get a decent rate post inflation and post tax. Remember, you have zero risk of default in that. You only have interest rate risk. And how do you beat interest rate risk? By doing an SIP. So this is the way to do. For a 60-year-old, I would first put 15 lakhs in senior citizen savings scheme. Then 15 lakhs I will put in Varishta Bima Yojana, an LIC annuity fund. And I would do that for the husband and for the wife, assuming both of you are above 60. So about 60 lakhs is already taken care of on your debt point of view. So only if you are investing surplus about 2 crores, should you be looking at debt funds, because assuming 1 crore you put in equity and 1 crore you put in debt. Out of it, 60 lakhs you have already put. The remaining 40 lakhs I would put to short-term income fund, I would put into medium-term income fund, and do a small STP in the GSEC fund. The others I would put into equity. So for 1 crore, this is how I get invested. 60 lakhs will go into government, post office and LIC schemes, and the remaining 40 lakhs would go into this combination of debt funds.
Okay. So that's how essentially you can structure a debt fund portfolio for yourself. Mr. Subramanyam Pichai, of course, wanted to know also for the people who've retired, who are above age 60. Okay, I think we have time for one more question. Vijay Lakshmi P asks us, what is the corpus one should have this year in 2020 to receive a regular income of rupees 50,000 from 2025 for the next 25 years by systematic withdrawal plan? Lots of moving parts really in this question, but anything, what would be your conjecture here?
If you ask me, it's a very longish answer because I wouldn't put all the money in debt. I would put some money in equity also. But I would straight away suggest that she should ask this from an advisor because I would put a little money in debt and little money in equity. Now, assuming she does not understand equity, she would need something like 65, 70 lakhs today in a combination of debt and equity so that it becomes about 1.25 crores at the end of another 5 years. Let us assume that is the rate of return she will get. Assuming she wants to make the corpus zero at the time that she is withdrawing, then she would need about a crore and 5 lakhs should be more than sufficient because she will keep withdrawing and that fund will also earn some money. 5% is what is a good rate I would think she would get in debt instruments from 2025 onwards. So if she withdraws about 6-7% from her corpus, she should be fine, which means about 1 or 2% will come from the corpus. And over the next 25 years, she will make the corpus into corpus zero. But if she wants to leave a corpus behind, then obviously she will need about 1.5 to 1.75 crores from which she will be able to withdraw.
Okay, so there you have it. That's a rough opinion given by Mrs. Subramanyam. Of course, we'd advise you to have a proper sit down with a financial advisor for a more detailed explanation with respect to the same. And yes, very rough. All right. Well, on that note, Mr. Subramanyam, we're completely out of time. So thank you so much for joining us on the Money Show and, of course, answering all the questions and queries, sent in by our viewers. Many thanks for joining in. You can, of course, catch this entire interview on ET Now's YouTube channel under the Money Show playlist. And yes, of course, don't forget that if you would like to connect with us on this show, get your questions and queries answered with respect to any topic on mutual funds, on financial planning, or even taxation, you can write in on the Money Show at etnow.tv. And on that note, we will slip into a very short break, but when we return, we will be taking forward the conversation on small cap funds and mid cap funds. There have been outliers, or should I say outperformers in this category. So in our Meet Your Fund Manager segment, we'll be talking to the manager of one such outperformer. Don't go.